thank you for joining us. You are attending the DBRS Morningstar webinar on the U.S. Commercial ABS 2022 Outlook. My name is Stephanie Ma. I am a researcher in our Structured Finance group, and I will be serving as your moderator today. I am joined by my colleagues, Sergey Masenko, an MD in our U.S. ABS group, Mark Hirschhorn, an SVP from our U.S. ABS group, and Josh Gatmaton, also an SVP from our U.S. ABS group. A few housekeeping items. Please feel free to type in any questions that you may have throughout the presentation. You should see a question mark on the bottom of your panel. You can click and type in your questions. We will address your questions at the end of the webinar. You should also notice that on the bottom of your screen, there is a referenced research note titled U.S. Commercial ABS 2022 Outlook, which was published last month that you can also review on the topic. You will find coverage on additional commercial sectors beyond those discussed today. Today, we will be highlighting our views on structured settlements, equipment leasing, aircraft, marine container, oil and gas, rental car, and small business. Heading into 2022, we seem to have been on better footing for the economy. Our baseline macroeconomic scenario pegs U.S. GDP growth at approximately 5.6% for 2021, and this is a level that has not been seen since the mid-1980s, and this followed a year of contraction in 2020. However, the spread of the Omicron variant and inflationary pressures brought on by rising energy prices and supply chain disruptions have stunted growth prospects for this year. The International Monetary Fund lowered its 2022 U.S. GDP growth projection by 1.2 percentage points to 4%. And this was based on earlier than expected withdrawal of monetary accommodation, the removal of the Build Back Better policy package from the baseline, and continued supply shortages. For asset classes where commercial-based obligors are the source of transaction repayment cash flows, among other things, GDP provides a basis for measuring performance expectations. While President Biden's $1.8 billion Build Back Better bill, which aimed to establish programs and otherwise modify provisions relating to a broad array of different areas, touching on education, labor, childcare, healthcare, taxes, immigration, and the environment, remains stalled in the Senate and is unlikely to pass. The passage of the Infrastructure Investment and Jobs Act at the end of last year should help support industries related to rebuilding America's roads, bridges, and rails, as the legislation aims to strengthen supply chains through investments in our country's airports, our ports, our rails, and roads. In particular, the equipment leasing industry should experience some uplift. In addition, demand for containers is expected to remain high due to the active trade flows combined with supply chain disruptions. DBRS Morningstar has positive rating outlooks on equipment lease and marine container ABS, stable outlooks for structured settlements, oil and gas, rental car, and small business securitizations. Aircraft is the only commercial ABS sector where we have a negative outlook, as the sector continues to be hampered by sharply lower air traffic. Glimmers of revitalization occurred in 2021, especially during the summer when leisure travel picked up, but business travel has yet to resume anywhere near pre-pandemic levels. In addition, the sector must also contend with the reintroduction of travel restrictions and thousands of canceled flights in the wake of staffing issues as the Omicron variant spreads. But now let's hear from Sergey, Mark, and Josh, who will go into much more detail on each of these commercial ABS sectors. Throughout our presentation, you will see a series of traffic light charts highlighting credit risks that we see across the respective sectors. For example, in the first column, we identify risks to the underlying pool of assets in the securitization, with green, yellow, and red colors to delineate low, medium, and high risks, respectively. Likewise, we also characterize the risk we see for different levels of debt across the capital structure, senior, mezz, and subs where applicable. Now let's start off with structured settlements. Sergey, please share with the audience our outlook and main observations for the sector.
Thank you, Stephanie, and good afternoon, everyone here on the East Coast. DBRS Morningstar has historically been active and continues to be active in structured settlement securitization space. Currently, for example, we have outstanding ratings on 43 such securitization transactions, which comprise a total of 77 different tranches. DBRS Morningstar did not observe any material impact on performance of the structured settlement ABS transactions during the coronavirus pandemic. Mostly, and main reason for that is the generally high credit quality of annuity providers and life insurance carriers. This happened as a result of the process following the Great Recession of 2008-2009, after which the insurers were encouraged and guided by the regulators to enhance their risk management frameworks and improve their capitalization. And so the capitalization across the insurance industry is relatively high and compares favorably to that observed during the Great Recession of 2008-2009. Also, another important factor is that structured settlements legal framework has been tested and proven over time. We now have all 50 states plus the District of Columbia having adopted some form of the Structured Settlements Protection Act. I think the last state was New Hampshire in the summer of 2021. As a result, the structured settlement securitization ABS continues to perform very well with zero or de minimis reported defaults and losses across all transactions that we rate. Strong credit performance has allowed more seasoned transactions to gradually build credit enhancement, which provides extra protection along the way against gradual negative potential migration of the rate of some insurance carriers. It's not frequent, but one of the well-known examples of such rating migration would be the ratings of Genworth entities, which are included in some portfolios that you see backing structured settlements ABS. For example, some earlier ABS rated by DBRS Morningstar included Genworth when it was still in a relatively high investment grade rating category compared to the current relatively low non-investment grade.
And Sergey, you mentioned that we've seen solid performance, zero or minimal reports of defaults and losses. But are there any trouble spots? Is there anything that's of concern?
Yes, Stephanie. One thing that is frequently pointed out is obviously the potential impact related to low interest rate environment that has prevailed for such a long time, and which may in the long run affect the investment earnings of insurance carriers. However, we haven't seen the significant negative rating action to date with regard to large, well-capitalized carriers that could be attributed to this. We expect this dynamic to continue in 2022. And another interesting trend that we do note, and we continue to keep an eye on it because it's somewhat harder to predict and can be happening unexpectedly, is the M&A activity that involves life insurance carriers. Such M&A activity, like acquisition by outside financial investor outside of the industry, may be beneficial, but in some cases may result in reassessment of the financial strengths and potentially credit ratings of the life insurers. Good recent example of such acquisition was the acquisition of Allstate Life Insurance Company, which forms part of many collateral pools in structured settlement ABS by Blackstone, which was completed, I believe, late, I think, in November of 2021. And lastly, I would like to use this opportunity to mention that in January 2022, DBRS Morningstar finalized its updated structured settlements ABS rating methodology, which now incorporates analytical approach regarding the so-called life contingent structured settlement receivables, which contain the claimant mortality risk in addition to the credit risk of the insurance company. We've seen a lot of interest based on the discussions with industry insiders to potentially investing in or structuring transactions that would be backed by this life contingent credit. And so in 2022, we expect to see the interest by ABS investors in rated securitization secured by mixed pool structured settlements, which include life contingent receivables.
And for those that want more information on that updated methodology, you can find that on our website, dbrsmorningstar.com, under methodology. But thanks, Sergey, for that update on structured settlements. But while I still have you on the mic, will you please cover equipment leasing next and go over what our outlook is for the sector?
Sure. Bottom line, we maintain positive outlook for equipment leasing ABS for 2022. We are also very active in the space, particularly focusing on independent lessors, both in large ticket and small ticket equipment space. The industry experienced brief period of stress, which was caused by the outbreak of coronavirus pandemic. And at the onset, DBRS Morningstar observed relatively high levels in some portfolios of temporary deferrals. Usually, deferrals were given for 1 to 3 months and could include, backloading the payments or allowing interest components only payments, or skipping the payments with the subsequent catch up in the following scheduled payment cycle. And some cases we also saw the increased or elevated levels of defaults in the portfolios. However, all originators in the transactions rated by DBRS Morningstar have since been able to bring the overwhelming majority, we essentially talking about 99% of customers back to the current status and current paying status. And it interestingly led to the phenomenon when the recent transactions include some obligors or a considerable amount of obligors that survived the pandemic and preserve their business and continue operating. So the battle-hardened obligors, if you will, form the big part of collateral portfolios for the most recent transactions. Current performance is very strong, with low delinquencies and losses observed across all transactions. As one example, good example of turnaround that followed the initial outbreak of the coronavirus, I would like to point at transportation industry. Since obligors representing trucking and transportation can feature many collateral portfolios, and it's a very popular collateral type. Following the recession in that industry in 2019, there was additional stress piled on from the coronavirus in early 2020. And that was ultimately reflected in performance of many recent vintages related to transportation. However, the trucking industry has registered a remarkable, for the lack of a better word, turnaround in performance, with ABS transactions featuring substantial amount of transportation assets performing very well. The originators also report solid secondary values given the shortage of, we have shortage of drivers, for example, in transportation, but also a shortage of trucks. And so originators are currently able to realize on off-lease collateral, and we expect the high levels of used values to be sustained through at least the first half of 2022. Many industry insiders obviously also point out at the potential and expected positive impact from the implementation of the Infrastructure Investment and Jobs Act towards the second part of this year. The success of the industry is also reflected in continuing interest from not only ABS investors in ABS security offered by sponsors, but in sponsors themselves. And in 2021, we saw another round of M&A activity when successful sponsors and originators were acquired. For example, among the sponsors of ABS previously rated by DBRS Morningstar, Encina Equipment Finance was acquired by Frontline BSP Capital, and most recently, Balboa Capital Corporation was purchased by Ameris Bank.
It sounds like the sector has fared quite well during the pandemic, and we've seen consolidation in the industry. But every day we hear about supply chain issues and the subsequent disruptions that they're causing. Sergey, have these kinds of disruptions had a negative effect on the equipment leasing sector?
Yeah, we hear that the lessors need to contend with uncertainty related to supply delays and manufacturing constraints. This may cause problems twofold. One is essentially you wait longer for equipment, and so it may delay the new bookings and new financing by lessors. And also, obviously, when equipment is not delivered and delayed, that can affect the manufacturing plans of the potential client, potential lessee, and undermine their financial condition and strength. So there is some impact of that, although it's not a hugely pronounced impact. Another concern is obviously rising interest rates. On the lessor side, they may suppress margins. On the obligor side, those may result in higher cost of financing and essentially make it harder for potential clients and customers of leasing companies to finance themselves and continue operating successfully. So that's something to keep an eye on as we go along in 2022.
Thank you, Sergey. Let's turn to aircraft next. Aircraft has been the commercial sector that has been the most negatively affected by the pandemic. At the onset, both leisure and business passenger traffic came to a near halt with the travel restrictions, closed borders, and fears about the new disease. At one point during the height of the pandemic, I think traffic was down almost 90% in some cases. Traffic has since rebounded, but not to anywhere near pre-pandemic levels. Mark, why don't you share your thoughts with us about our outlook for aircraft ABS?
Great. Thanks, Stephanie. Good afternoon, everyone. In following with Stephanie's original comments of how we think about credit risk mapping, we generally view aircraft ABS as having medium to higher risk, as you can see on the slide. More specifically, we continue to see a bit more risk with respect to the most subordinate tranches and also the equity tranches in these transactions. While the industry has certainly seen significant improvement since the trough at the start of COVID, some questions do remain.
Yes, indeed. The main question is whether passenger traffic levels will ever recuperate and return to pre-pandemic levels. Mark, please walk us through this next slide and share your observed trends on passenger traffic.
Sure. As you can see on the slide, traffic has really rebounded pretty nicely and has approached 80% or more in certain periods of pre-COVID levels. While this is expected to continue to improve, with the ongoing pandemic, there still is some lingering uncertainty. Questions certainly arise as to, first, business travel, and second, international long-haul travel. It's likely that some portion of pre-COVID business travel may never return. Also, with respect to international routes, passengers, whether they're leisure or business, are likely to take a little bit longer to decide whether and when to partake. Both of these situations can create pressure on capacity and in turn, number as well as values of aircraft that may no longer be necessary. We believe this to be especially true for older aircraft types, meaning non-neo and non-max for narrow bodies, as well as previous generation twin aisles.
Mark, aircraft storage rates are also scrutinized in the industry. since they've been viewed as a barometer of global aircraft activity. Pre-pandemic, storage rates were typically, I think, at or below 10%, depending on aircraft type. Generally, aircraft are in storage for a few different reasons, including maintenance, low season, or disposition preparation efforts. What are you seeing here specifically when we drill down to wide body versus narrow body?
Yeah, sure. Thanks, Stephanie. So on this slide, it's a pretty busy slide, I guess, but you see global storage rates for aircraft in a few different categories. In the first one, you can see narrow body versus wide body. So generally, obviously, the storage was much higher at the beginning of the pandemic. It levels near 60% for everything, pretty much, if you look at the top chart. But then as you see over time, the narrow bodies recovered much faster, down to 20% in storage now, whereas the wide bodies continue to be in the vicinity of 25 to 27%. So still good recovery, but not quite as good as the narrow body, which is more usable in the routes that are being traveled today. Getting back to what we talked about before with respect to long haul travel. The second set of charts at the bottom just shows you a little bit about which aircraft types are more or less in storage. So interesting piece on the left, you can see that the purple line is a 737 MAX and started out basically 100% in storage. And it wasn't necessarily COVID related, it was more related to the grounding. But you can see how that recovered once the grounding ended at the beginning of 2021, and the storage rates of those, while still a bit higher than some of the other narrow bodies, is down toward 20-25%. You can see the most attractive narrow bodies are down in the 10% area at this point, 10-15%. If you look at the A220, the 737 NG, for example, and the A320. Similarly, you can look at the wide body side, and you can see the recoveries for the newer aircraft types, the A350s and so forth, whereas the A330, which is kind of on its way out at this point in time, still up around 35 to 40%. So you have a wide range of storage, but and ultimately, and we'll talk more about it in a few minutes, this has an impact on values and other factors.
And given the factors that you mentioned, Mark, how have values been affected in any way?
Sure, I'm happy to take that. A significant portion of the potential impact has already been realized, as you can somewhat see on this slide. This slide shows a comparison between current market values, or CMV, and the base value of the aircraft, which is more of its intrinsic value. Percentages above 100% represent a strong market, while those under 100% represent a less liquid environment. Of course, during 2020 and to a lesser extent 2021, significant value reductions were seen, up to 50% for some wide bodies. So further impacts in 2022 and beyond may be somewhat muted overall and more limited to certain specific types. On the upside, there has been some stabilization in values for the more attractive types, like the Neo and the Max, including in some cases some small value increases. Recently, after initial decreases, turboprops and regional jets seem to have stabilized. We don't see those as often in the transactions that we look at, but they do pop up from time to time. With respect to the less liquid types, out of production variants, and especially twin aisles, there could be more pressure on the horizon, impacting liquidity and possibly affecting previous transactions. As I alluded to before, aircraft like the A330 or the 777-300ER may not have necessarily good homes, and so values may be further pressured. On a positive note, why don't we move over to freight? So in this slide shows the same measurement, CMV versus DV of freighter aircraft. So the strength of the cargo market has been evident throughout the pandemic. Consumer demand for e-commerce items Ongoing supply chain issues and port delays have kept freighters highly utilized. This could indirectly support values of older passenger aircraft and certain engine types. A number of new conversion programs have been launched which can provide a solution for unwanted wide bodies, for example, the ones I mentioned before, the A330 and the 777-300. The market has been so robust, Airbus recently announced its intention to build a freighter version of its popular A350 aircraft. So as you can see demonstrated on the slide, the freighter values are generally strong with DMV ratios significantly north of 100%. While we don't feel that this strength is necessarily sustainable in the long term, we expect it to hold up relatively well over the next few years. So that's, as I said earlier, definitely a positive note on the aircraft industry.
Mark, so far we've covered passenger traffic, storage rates, and aircraft valuations. During the pandemic, we have also seen a few airline bankruptcies as well as some industry consolidation. Would love to hear your thoughts on how this is affecting the sector.
Sure, I can touch on that and also a few other industry factors and how they relate back to aircraft ABS and similar structures. Yes, there have been, I don't have the slide for it, but there have been an elevated number of bankruptcies, mostly in 2020, some more in 2021, and I assume we'll see some more in 2022. However, some airlines like Aeromexico and Avianca are starting to emerge from bankruptcy. For those, it'll allow them to once again lease aircraft, catch up on any previously missed payments, and confirm existing leasing arrangements. To note also is a recent merger announcement by Spirit and Frontier, which would suggest that the airline industry is normalizing around the post-COVID world. The merger of the two discount airlines would create the 5th largest domestic carrier. Past transactions have included both of these operators. Perhaps the combination can provide further comfort with respect to ongoing cash flows. Another topic that I alluded to earlier, the 737 MAX has been recertified and is flying in multiple jurisdictions via more than 35 airlines. This bodes well for storage rates, which we already saw the improvement on, values and lease rates, which had been somewhat suppressed since the grounding. Separately, issues continue to linger for the 787 wide-body product due to the higher level of regulatory scrutiny, which has delayed new deliveries until at least the third quarter of 22. Obviously, that's indirectly impacted by the experience with 737 MAX over the past few years. Something we haven't spoken about recently is inflation. For the most part, over the past couple of years, our analyses have typically incorporated inflation assumptions at or near 0% with respect to primarily aircraft values, which also impact cash inflows. Considering the current environment and increased inflation, lease rates and aircraft sales proceeds will likely be higher on an absolute dollar basis, providing more cash and better protections for existing transactions relative to at least our model performance. Overall, since the start of the pandemic, with respect to aircraft ABS, I would say that market has been fairly resilient. After shutting down for the most part in 2020, issuance rebounded in 2021. Looking at issuance of pure aircraft ABS, exclusive of business jets and engine deals, we counted approximately 11 deals in 2021, totaling near $7.5 billion. During this period, operators with good credit and collateral were able to take advantage of low financing rates over longer terms, while also achieving ESG objectives. To quell investors' concerns for post-pandemic transactions, structural enhancements observed in the deals include shorter debt service coverage ratio test periods, oftentimes coming from 6 months down to 3, unencumbered security deposit accounts, increased liquidity facilities, faster amortization profiles, and shorter legal final maturities. Recent transactions have featured a much wider diversification of collateral, including next generation aircraft, younger narrow bodies, and in some cases, freighters, which obviously, based on the earlier slide, can benefit from transactions. Underlying obligors tend to be somewhat better as well, on average, mostly second tier and first tier airlines. Just in closing, though there are a number of positives, credit deterioration in the pre-2020 transactions continues to be an ongoing issue. DBRS Morningstar maintains the view that transactions that include third tier or less known airlines particularly in jurisdictions where no sovereign or government support is available, may continue to struggle with cash flow. Additionally, transactions that include wide-body and older narrow-body aircraft have seen accelerated depreciation rates, as well as weak disposition results with fewer buyers. While DBRS Morningstar expects the most senior of the notes will get their principal returned, other classes could struggle unless cash flow conditions improve. 2022 was off to a good start, though. In addition to aircraft ABS, we've seen a number of different structures, primarily in the private market, ranging from secured loans to lessor EETCs. We expect the pace to continue in 2022 for both transaction types as lessors and other aircraft owners look to finance existing portfolios and new ESG-driven purchases.
Thank you, Mark, for that very comprehensive overview of what's going on in aircraft ABS. In contrast to aircraft, marine containers has fared much better during the pandemic. We've seen healthy trade flows with further growth projected for this year. Sergey, please walk us through what you're seeing on the marine container side.
Sure, Stephanie. Marine container leasing industry is riding high currently, and we expect the solid performance to continue throughout this year. There was a brief period of stress that you alluded to when early in the pandemic, throughout the world, there were experienced kind of rolling, essentially lockdowns or shutdowns of trade infrastructure, resulting in stoppage of trade and creating stress on the industry, including container lessors. So the first half of 2020 saw very little, close to no production of new boxes. However, the industry rebounded strongly with resumption of trade flows, and the demand for container boxes was further increased by still local lockdowns happening, which occasionally stranded containers in ports, at sea or onshore, and other logistical bottlenecks, which are well publicized. Following the bounce back in demand for boxes, the container production in 2021 increased very sharply after relatively modest, kind of generally close to average production levels in 2019 and 2020. The reasons for that modest production in 2019 and 2020 were obviously different. 2019, it was more attributable to general economic environment. In 2020, the first half saw very little production when the production rebounded in the second half. We expect that there will be normalization of the production and demand back to some form of a replacement cycle over the next few years, but still expect a fairly healthy demand for containers in 2022. In the meantime, it should be noted that the clients of container lessors, the container shipping companies, continue to report record profits with favorable outlooks through at least this year, if not going into next year even. And they benefit from high volumes and freight rates that started trending upwards in 2020. And at least until recently, relatively recently, the fuel prices has held steady compared to freight rates, which kind of skyrocketed, even factoring the higher cost of low sulfur fuel, which was introduced to be compliant with IMO 2020 regulations. We continue to monitor also the interesting and obviously currently beneficial for the collateral portfolio's trend of longer initial lease terms. For example, in its fall investor presentation, I think it was Triton International reported that average lease term for their investment in 2021 was about 13 years. Obviously, this is a result of a favorable market environment for container lessors with high demand coming out of supply chain disruptions during the pandemic. And as a result, we are seeing the leases locked into terms that essentially span the life cycle may spend the life cycle of a container.
Sergey, we've seen solid performance and record profits, but are there any trouble spots or any other important trends in the industry that you think are worth highlighting?
I wouldn't go as far as trouble spots, but I would point out an interesting conversations we've had with several industry insiders, which point out to an interesting trend where it sounds like the lessors are experiencing an increase in concentrations to select large container shipping operators, specifically those that tend to favor leasing versus buying, and those include some of the largest container shippers. The container shipping industry is very concentrated, and so this is not surprising given high demand for boxes. But from the perspective of the rating agency, the increasing lessee concentrations may result in collateral pools that basically could be potentially secured by less than a handful of shipping companies, which in turn may lead us as a rating agency to consider whether we need to revise or update the scale or the manner in which we apply stresses to long-term leases should such collateral pools become more widespread and prevalent. The overall, though the outlook for leasing industry in 2022 is positive, like I said. The utilization and per diems in near to midterm will be helped or should be helped by the high share of long-term leases in lessors portfolios and all those attractive per diems that they've been able to lock in for longer terms in 2021 and the second half of 2020.
Thank you, Sergey, for that update on marine container. Let's turn our attention to the next commercial ABS sector. With rising commodity prices, much attention has been focused on oil. Josh, let's hear from you about what you're seeing in the oil and gas PDP sector. But I think perhaps before we start to delve into our outlook and our observations, it might be helpful to take a few steps back first and identify what exactly gets put into these securitizations.
Well, thanks, Stephanie. Good afternoon to everybody. That's a great segue to the discussion now on oil and gas, particularly the conversation with my colleague Mark and yourself on aircraft and the impact of COVID and what's happened since then. So, taking a step back, the DBRS USABS team focuses on upstream oil and gas PDP securitizations in this space. And what this is just a form of reserve-based lending dependent on the value of oil and gas reserves. So essentially, it's just another type of asset-based financing where the value of the underlying but specific pool of reserves determines the amount of money advanced. And then the cash flows generated from these reserves are used to pay down the debt from the securitization interest and other associated transaction expenses and fees. To your question, though, what's securitized in these deals? What's securitized really are either operating and or non-operating working interests. So by operating, this means that there's a direct responsibility to operate the wells in these transactions and direct responsibility for expenses. And then non-operating just means the opposite of that, where there's no direct responsibility to operating the wells, but there is an economic interest in the wells and production from these wells. So these can include, the actual well bores, mineral royalty interests, hydrocarbons from such well bores, and the associated cash flows generated by these. And then on slide 11, which you have on now, it's a great slide. It really paints the picture of the different levels of reserves from a technical and commercial certainty space. So perspective. And this chart is from the Society of Petroleum Engineers. So at the lower, if we start from the lower end of this chart, you're really looking at the the level of resources that are undiscovered and of potential commercial value only. So these are the level of resources where the range of technical uncertainty are at its lowest and its commercial value are at its lowest. But if you look at the top of the chart, at the rightmost, you'll find where the ABS team focuses on, which are PDP reserves, or proved developed producing reserves. And these are reserves that are of the highest technical certainty and of the highest potential commercial value. And these characteristics make it ideal for securitizations, given the stability to cash flow, potential stability to cash flow that those properties of these reserves provide. Just to elaborate a bit more, when we say proved, what we mean there is that it's past, the reserves are past the discovery phase. And then by developed, what we mean there is that production is essentially expected to be recovered from the existing wells already. And then by producing, we mean the wells are open and producing or flowing at the time of estimation of production. And as you'd expect, these are commodities. They're exposed to commodity market prices. These transactions, a majority of the production is hedged by a highly rated investment grade counterparty. And that's pretty important because at the onset of COVID, when we saw unprecedented downside volatility, the severe oil price downdraft that occurred, these hedges actually mitigated a lot of that price dislocation that occurred. So that I thought that was important to mention. Speaking
of volatility in oil prices, Josh, let's discuss what you've been seeing on that end more recently.
Yeah, no, that's a pretty important part here. You can say there's a bit of a wind behind the space at this point, but not after the dislocation that we saw on the onset of COVID, the surges in COVID and its variants. So there's a chart on slide 12 that shows the crude oil prices and natural gas futures prices between these two charts. So if you could look at it, you could basically summarize the trend being, the onset of COVID, the sharp downdraft in demand impacting price. And then as you continue through the period post-COVID, as economies reopened, demand resurged, so to speak. That happened against, after producers had reacted to the downdraft from the price decline, adjusting, production levels and costs to maintain their economics. So that resurgence and reopening happened against a backdrop of undersupply, which in part has driven higher trending prices in both areas at this point. Gas also having weather-related forecasts affecting, where prices have also been supported. But, just taking a step back in terms of prices, not long after the onset of the pandemic in early 2020, we actually saw crude oil go negative on April 20, 2020, and was only at $19 per barrel at the end of April 2020. Natural gas prices languished below $2 per MCF until about early August 2020. Now, pricing has come a long way since then as economies reopened, like I mentioned, and travel resumed, as Mark has discussed in yourself in the aircraft. After hitting an interim peak of $76 per barrel on July 5, 2021, crude oil prices retraced on fears of the economic impact from, like I mentioned, the Delta variant, and then again with Omicron, like we saw. But now we're above $4 MCF. I believe as of this morning, it's at 4.62. So we've come a long way from the bottom of COVID, which in itself is a wind behind the space at this point. just to elaborate a little bit more, when COVID hit, we actually saw, wells get shut in, which is pretty much a reaction to, the unprecedented drop in oil prices. There were also storage capacity issues that were behind that development. So that occurred at the onset of COVID and brought about that steep fall in demand and storage issues, like I mentioned, that transpired during that time. These have all since receded. The actual higher price environment that we're seeing now has provided more incentive to have as much production back online at this point. So for crude oil, this surge in price since last fall has been driven by three forces, if we were to name three factors at this point. So first is the gradually improving global oil demand caused by the reopening of the world economy. Second, a slow and cautious approach by OPEC Plus and US shale producers to increase production. And then now, the recent threat of war between Russia and Ukraine, which could disrupt Russian energy exports if that were to occur.
Thanks, Josh, for this great mini primer. Now that we have everyone up to speed on the underlying collateral behind the oil and gas PDP securitizations, let's turn our attention next to our outlook.
Sure, Steph. Thanks. So our view on the area is that we have a stable view on the space, given what I said we've seen in production level improvements and improved pricing trends. Certain metrics like production tracking rates, which is a measure of your actual production versus expected or forecasted production, have improved, along with debt coverage ratios in these deals. So those are positives that we're seeing so far. But that's not to say there are risks to the outlook. One obvious one is the emergence of COVID variants that could result in restrictions on mobility and travel, and that could impact demand significantly once again. And then second, that factor I mentioned, the disruption of supply for war-related reasons, due to Russian energy exports or any other supply disruptions that could result from the escalation of war or the actual war occurring at this point.
Thanks, Josh. I know we have a couple more sectors that we need to plow through. Let's switch gears a bit and turn our focus next on rental car. At the onset of the pandemic, the rental car industry was severely battered, but has since been climbing back up from that valley. Mark, if you could share your thoughts on what's going on in the sector more recently.
Yeah, sure, Stephanie. As Stephanie said, at the beginning, it looked like rental car was going to follow in the same footsteps as aircraft and be severely challenged, but certainly the paths did diverge. In general, over the past year, the rental car ABS segment has performed quite well. The performance followed some difficulties in 2020 at the start of the COVID pandemic, when auctions were closed and operators like Hertz had to sell vehicles quickly. Further, bank and other funding dried up for rental car companies, and Hertz was forced to file for bankruptcy. During this time, as it turned out, too many cars were sold as the rental market rebounded fairly quickly, causing shortages. Ultimately, starting in mid-2021, for the most part, the rental car ABS segment has been strong and looks to continue that pattern into 2022. Post-Hertz bankruptcy, rental car operators have been more profitable, rental rates are up, and realizations at disposition have been elevated. Taking into account these factors, but also the longer-term potential variability, we view this sector as stable. So let's talk a bit about some of the metrics. First, there's currently a strong demand for cars, both on the rental side and also on the disposition side. The initial factory slowdowns and ongoing computer chip supply chain issues with the OEMs have resulted in a shortage of cars, which has encouraged drivers to rent, in addition to seek available used cars. All this provides for strong revenue streams for the rental car operators. In addition to having more buyers, the shortage also results in higher proceeds on sales. Looking back over transaction performance in general, In pre-pandemic times, operators typically realized somewhere between 100 and 130% on the book value. Over the past year and a half or so, that metric has generally increased to a range of somewhere in the vicinity of 130 to 160% of book value. While these elevated levels won't last, operators are reaping the benefits currently, and we believe will continue to do so into the rest of 2022. On the other hand, shortages of cars from OEMs have and can cause lost revenue opportunities. To the extent that an operator can't fill vehicle demand, cash is left on the table and customers can be disappointed. Next, I'll turn to fleet characteristics. Historically, some portion of an operator's fleet has consisted of program vehicles. These are vehicles whereby the OEM either provides a repurchase obligation or a guaranteed residual, thereby shifting residual risk to corporate risk. Recently, the proportion of program vehicles has decreased as the terms being provided by the OEMs have not been as attractive. Further, OEMs have not been offering the program as regularly as they once had. In any event, rental car operators see more upside from non-program vehicles and seem to be content with these reduced levels, obviously based on what I said earlier with respect to the disposition proceeds at near 150%.
Thanks, Mark. Whenever the topic of cars comes up, and that whether it's rental cars or auto loans, the conversation naturally dovetails to electrical vehicles. How do you see the incorporation of electrical vehicles into rental car fleets affecting the sector?
So Hertz has indicated its intention to purchase a significant number of Tesla vehicles for its fleet. But while it's expected that eventually larger proportions of the U.S. car market will be EVs, the U.S. remains mostly an internal combustion engine country. While it may ultimately prove out that EVs can hold values and be covered by significant demand, with limited disposition history, it's hard to say exactly what the results of market sales will be. Factors not seen with combustion vehicles, including potential obsolescence, lack of charging infrastructure and supporting services, and the fact that a large proportion of the EV's value relates to its battery could affect such sales. Some good news recently with respect to infrastructure is the plan to install more charging stations on highways, which would mitigate one of those aspects that I mentioned. Anyway, to date, while limits are increasing to some extent, very little EV exposure has been seen in the transactions. As the actual amounts increase, DBRS Morningstar would expect to examine relevant data and, as appropriate, adjust its analyses accordingly. In closing, the rental car ABS structure is a well-established one that has been used by the larger operators in the space. It has proven itself over the years and provided for, ultimately, full payout to investors post-Hertz bankruptcy with no losses incurred. Hertz was able to effectively defleet, allow its existing structure to pay off investors in all series, then subsequently initiate a new structure mimicking its original structure for the post-bankruptcy Hertz. The mark-to-market and testing mechanisms have continued to operate well. Situations where portfolios and/or credit enhancement increases are required have been rare for ongoing structures. With that in mind, we expect continued strong issuance and stable performance in the sector.
Thanks for the update on rental car, Mark. This brings us to the final commercial ABS sector that we will be discussing today. Small businesses have been especially vulnerable during the pandemic, given lower consumer foot traffic, supply chain disruptions, and employee absences due to sickness. Sergey, how have small business loan ABS transactions been holding up?
Sure, Stephanie. I know we should be mindful of time, so I'll try to be quick, but really it's a very fascinating subject. Small business loans were one of the rare sectors during the pandemic where the performance of collateral pools securing the transactions, for example, rated by DBRS Morningstar, was stressed enough to essentially go through the rating agency stress scenarios with a sharp increase in delinquencies and defaults from the onset of the pandemic. But I should say that despite considerable performance shock early on, the ABS structures proved their resilience in the face of this significant stress. And even subordinated tranches didn't experience rating downgrades, with timely interest payments being made and full repayment of principal to the ABS investors. So that proves the resiliency of the existing ABS structures geared to that particular sector. Other factors, in addition to the transaction structures that helped to carry these transactions through the initial lockdown shock, there could be several mentioned here, but I would highlight the efforts by sponsors and their collection teams and the servicing teams. The tremendous effort was made to maximize collections and guide the obligors towards potential repayment scenarios, with another very helpful factor. For example, one of these potential repayment scenarios was the Paycheck protection program, which had been quickly put in action by the U.S. government. And what we've seen in transactions that we rate, the real pickup in prepayments or repayments during the period when the program was introduced, which really helped collections and repayment of the outstanding ABS. Performance has been stabilized. It's not only seen in the transactions that we rate, but also in broader indices. For instance, if you look at the PayNet small business 31 to 180 day delinquency index, it was near historical lows as of November 2021, for example, and the PayNet small business annualized default index has come down significantly off of the pandemic highs. The PayNet also compiles the small business lending index. They also do it on a 12-month rolling basis, which shows the ebbs and flows in the lending activity to the sector. So that index also recovered on a 12-month rolling basis starting early last year after some dip was experienced during the pandemic. We're cautiously optimistic about the performance of the sector in 2022, despite several challenges facing small businesses. We've already discussed them in the context of other commercial asset classes, supply challenges, rising interest rates, labor shortage, which all may put pressure either on financing costs for the businesses or expenses, and the ease with which they can attract capital and conduct their business. One interesting point also is that pickup in domestic oil and gas production activity because of the higher world oil and gas prices seemingly has not yet materialized in force. That's another area where a lot of small businesses and equipment lessees tend to be involved, but we haven't seen the substantial pickup in activity. On the other hand, when we go back to normalcy post-pandemic, some sectors of small businesses may be the largest relative beneficiaries, such as the retail services, food services, as well as hospitality. And also similar to equipment sector, the small businesses would be expected to benefit from the Infrastructure Investment and Jobs Act implementation that should provide additional tailwind towards the end of the year.
Thank you, Sergey, for that update on small business. This concludes our prepared remarks for the webinar. We're just up against time, but we'll try to extend 5 minutes for those that can stay on to address any questions. Again, you'll see a question mark on the bottom of your screen. You can click out and type out your question. I think I saw one or two during the presentation. Just bear with me. Mark, this one looks like it's for you. Can you elaborate more about the inflationary pressures on aircraft ABS transactions? If prior assumptions typically incorporated inflation at or near zero, does DBRS expect to make any adjustments sometime this year?
Sure, Stephanie, I can take that. Yeah, as asked, yes, the inflation rates that we assume in some of our modeling, or in most of our modeling, I should say, has been close to 0%. I mean, our methodologies allow for a bit of a range from about 0 to 3% to be used in the analyses, but most recently we've been trending towards 0 because that's kind of where the environment has been. So what that does in our modeling is it in a way drives down aircraft prices, depreciating aircraft prices, because you would add on some amount of inflation to keep the number slightly higher. You know, sometimes appraisers and bankers might use some sort of inflation factor to keep that number a bit higher over time. So at 0, we've been modeling it at slightly lower levels. Now with the recent increase in inflation, we might think about possibly raising that, which would have a couple impacts. Obviously, it would increase the value of a depreciating aircraft later on, but by 1-2%, whichever number we choose. But the other impact is on maintenance costs. So we'd also have to adjust. The maintenance is a big chunk out of the cash flow of these transactions, and if the cost of maintenance is deemed to be more subject to inflation than it was previously, then we also have to raise that. So the two would probably go a bit hand in hand. Ultimately, in our modeling for aircraft lease deals, the value of the aircraft drives the future lease rates. So by increasing the inflation, the future lease rates would also, would also go up. So, I think we'll look at it, we'll consider it. We may decide to move a little bit up in that range, but we are still a rating agency, so we may just keep it relatively conservative and on the lower end of that range. But we'll see over the course of this year how it plays out.
Thanks, Mark. I think we have time for only one more question. This one looks like it's for Sergey. It's on, I think, small business. Given inflation, supply chain issues, and labor shortages, small businesses are under pressure. What makes the senior notes resilient? Does DBRS Morningstar intend to apply additional stresses in its assumptions?
No, Stephanie, at this point, we are not contemplating additional stresses to be applied in the sector. You are right pointing out that the risk factors, however, there are positives that I just listed while talking about small businesses. And generally speaking, the structures, we had a test case for the structure really with a severe stress, basically close to rating agency stresses assumed in testing these structures during the recession, and the structures performed well and withstood the pressure. And now, given the bounce back in performance, we think the current structures are adequate without any additional stress assumption. We remain cautiously optimistic in anticipation of the full return of the economy to normalcy, which would be greatly beneficial for small businesses, particularly in areas such, like I said, retail, food service, hospitality. Government programs can further boost construction, transportation, manufacturing, where a lot of small businesses also involved. Challenges remain, but we'll continue to keep an eye on the sector, but no, without at this point applying any additional stress.
Thanks, Sergey. I think we are totally out of time. Thank you to Sergey, Mark, and Josh for joining us, and thank you, the audience, for taking time out of your day. We may have missed a question or two, so please, you see our contact details on this slide. We encourage everyone to read our latest research commentary titled U.S. Commercial ABS 2022 Outlook, which is linked at the bottom of your screen. Again, you'll find coverage on other consumer ABS sectors that we didn't have time to cover in the webinar today. As a reminder, this webinar is being recorded and will be available for playback should you wish to revisit any discussion points or share the replay with colleagues. Thank you again for joining us, and enjoy the rest of your afternoon.